another minute. Okay. Let's just give it another minute. Let's see, anything in the news to talk about these days? Or we not yet ready to ask if there are any questions, but I will soon be. But anything interesting in the news of late?
The Chinese government.
Okay, right. So I guess like for local news, I guess the Chinese government imposed a stimulus.
Yes,
For a certain amount of money. Right. Right. So the argument there was that the Chinese government says we're going to spend a lot of money, and that raised the stock markets. Now, why did that raise the stock markets if we're going to spend a lot of money? The argument is that that if they create more economic activity, that will help all the companies in the stock market, basically, because there'll be more people buying more things, okay, and that's normally a good thing for the stock market, assuming the country doesn't do it too much. I guess the trade-off would be that if you announce too much of a stimulus package, the trade-off there is that sometimes causes inflation. Okay, that if you create too much economic activity, suddenly there's so much going on. Prices tend to rise. Okay, because if so many people are eager to buy, if too many people are eager to buy things, prices rise by supply to demand. And so there's sort of a trade-off between how much stimulus you should offer and trying to keep inflation down. And that's, I guess, why just offering more stimulus is not always the best thing to do. But when the government, when the economy is doing badly, it is a good thing to do. And so that's, I guess, part of the news. The other news, we remember Barack Obama got elected. Everyone thought Barack Obama getting elected was a very good thing. So what happened to the stock market right after Barack Obama got elected? Did it go up or down? Well, okay, I think it went up before he got elected, when everybody thought he was going to get elected, and then it went down afterwards. And that is somehow somewhat of a pattern one sometimes sees, that they say buy on rumor, sell on news, okay, is one sort of wave. So somehow that, again, we're going to start in this section of the course, we're not going to start trying to talk about trading systems or what makes a good investment in some sense, or at least what are interesting trading strategies. One argument would be that you're supposed to buy on rumor and sell on news. Okay, you can figure out what that means. So when the thing actually happens, then people tend to cash out. But okay, let's now I guess we're starting to get a quorum here. Are there any questions? I think there is a question. What is your question?
I want to know if the power exam of this course
Okay, so let me talk a little bit about. I started getting a little bit of panic about the final exam, and I don't know for people last class, and I want to try to assuage some of the panic. Okay, but so what is the final exam going to be? The final exam, as far as I'm concerned, is to make sure, give you a strong encouragement to study the notes that we have, the lecture slides and the notes, to make sure you understand what we've been talking about in here. So my plan is that there will be a closed book exam. So the lecture note, the exam will be a closed book thing. It will be largely drawn from the notes. Okay, almost completely drawn from the notes, to be honest with you. It will be a variety of what I will call short answer things. So a lot of it is going to be stuff that, if you remember the exact phrase from the notes, you can write it down. Some there will be things that you have to think through and what the implications of some of the things that we talked about are. I also recognize that there's a lot of things that we covered in a fairly casual way that I'll talk about, big theory, how does FFTs work? That got people nervous last time. And I'm not going to ask you, questions about things that I don't really explain on the slides. So I wouldn't expect people to know the details of how an FFT works. On the other hand, in the level of depth that I present them on the slides, I think that is fair game. Okay? So the other vision is, of course, that I curve the grades in here. So if I were to give an impossible exam, all you have to do is do better than everybody else who's failing, and you're doing fine, right? I don't give impossible exams in general, but basically things will be curved. It will be short answer things, okay, largely drawn from the notes. So how should you study? The right way to study is to read through the notes, figure out what's important, okay, and review it that way. Any questions about that? Okay? That is not meant to frighten anyone. The other thing that I'm going to give back at the end of class today, we graded the homework ones. Again, everything is going to be curved, so don't immediately get panicked. How did we grade the homework ones? We read through all of them, looked at how well you answered things that we talked about on the assignment sheet. Put the papers into 3 bins, basically. The top third, the middle third, and the bottom third. And then gave scores based on what bucket you were thrown in. Okay? So when you asked why did you get an 80, it was because you were in the lower third bucket. Why did you get an 85? It was because you were in the middle bucket. Why did you get a 90? You were in the top bucket. There were a small number of people who I moved up a little bit from a bucket score because I thought they did a particularly good job in their bucket. Okay? But that's basically what happened. Okay? So don't panic regardless of what your scores are. Again, everything will curve, and the vision is that anybody who puts forth an effort in here will certainly get a B or better. Okay? That's sort of the vision I promise people. Okay? Any questions? Okay? Okay, so that said, what I'd like to talk about today, any other questions about the exam or grades or panic? Shouldn't be any panic. Okay, yes.
I have a question about the project.
Yes.
So I'm going to finish the project. Do I need to give a presentation about my project?
Okay, so the question about presentations for projects. For the people who did not do presentations so far, there is no moral requirement that they do a presentation. Okay, so I'm willing to accept a written report for that. That said, if you've done something interesting and you'd like to talk about it, I would actually encourage that. Okay? Now, of course, I encourage you doing something interesting. Okay, not everybody will have done that. Okay, but if you think you've done something interesting and you'd like to show me the results, let's say a couple days before, the week before, okay, and say, hey, I'd like to talk a little bit about that, I'd be very happy to have you do that. Okay? If not, we can communicate through a written report. But if you have something interesting to show, I'd like to see you talk about it. As I normally taught this class in the past, it had a much larger project component. Okay? And people were working aggressively on projects all semester and presenting progress reports and things like that. And I changed it this semester, and so I didn't really have room for project presentations in theory. But on the other hand, I would be interested if people think they've done something interesting to present that. Any questions? Yes?
Yes, I want to know some more about the project as I also do the project, but to read it with the source code or only the written report.
Okay. I will probably, what I tend to do is, I am most interested in, for the projects, the written report, because that's somehow what you've actually done. On the other hand, I encourage everybody to put together a web page with everything on it and say, here's where everything is. Okay? So, I mean, unless there is some reason why you're frightened by showing me your source code, okay? Which I wouldn't imagine. I think it'd be a good thing to, in general, it's a good thing to have. I'm not so much interested in reading source code as I am interested in reading reports. Okay? Any questions? Okay? Any other questions about grading or anything like that at this point? Okay, so what I wanted to talk about today was, I decided to take a little detour. We've been talking, first part of the course we talked about options pricing. Second part of the course we started talking about time series analysis. I have a couple of other things I wanted to say about time series analysis, which I might say like the last week or so. But I decided I wanted to move the third chunk of the course up a little bit, or keep it on my original schedule, because I think it's something people will find interesting. And I think it's relevant to what your second homework is going to be. And I'm going to pass that assignment out today. And it has to do, when I want to start looking at really sort of questions about trading strategies and investment strategies and things like this. So the question really is, the thing people came into the course probably wanting to be able to do was to figure out how do I, quote unquote, beat the stock market or something like that. Now, hopefully what we're going to learn is why you're not going to beat the stock market, okay? That's one of the things we hope to talk about during the this section. But more to the point, there are interesting things to do, even if it is not somehow picking the best stock or something like that, which is what people normally come in here thinking about the way they're going to work about it. So we're going to talk about, for what I hope is the next section of the course, and maybe it'll make it to the end of the semester, or maybe within a week of the end of the semester. We'll talk about trading strategies, okay? And for this, I guess I find it helpful to think about partitioning the jobs of people in the finance industry into a couple of different categories, okay? So there are people who are money managers, okay, investment managers. And these people's job, in principle, is to, given a certain amount of capital, given a certain set of financial goals, okay, try to figure out where should I put my money so as to achieve those goals as well as possible. What are perfectly reasonable goals? Well, one is obviously maximizing your returns. That would be one obvious goal. A second goal that should be more obvious in today's climate is a question of limiting risk. The hedge funds have done a great job of maximizing returns in recent years. Many of them are going to go bankrupt in this year, okay? And that's because they may not have done as good the issue of how much risk they were exposed to was an issue. There's issues of liquidity, okay? When you buy an investment, the question of how quickly can you get your money out of it, okay? And many people, when they see the markets fall, okay, sometimes in certain kinds of investment, you cannot move your money very, very quickly or something like that, okay? And so there's certain goals you would have. A money manager, I would say, would try to build strategies to achieve those goals. Now, there is a second kind of person who's called a trader, okay? And a trader is someone whose job it is to implement a strategy, okay? So a money manager may say, we have to buy Google. We have to buy 100,000 shares of Google, okay? And that's fine, but there's ways you can buy 100,000 shares of Google. You could buy 100,000 shares of Google by putting an order out on the market for 100,000 shares, okay? Or you could break your order into smaller chunks, buy 100 shares of Google at a time, okay? And there's issues of what are the right ways to do these things, okay? Let's get into some interesting kinds of questions. So I picture that there's strategic issues, which I picture the money manager as dealing with. And there are tactical issues, which I picture the trader as dealing with, okay? And both of them have room for certain levels of mathematics and strategy and algorithmics associated with it. But we should distinguish between what those two missions are. Any questions? Okay? So what we're going to try to do in this section of the course is discuss various aspects of things these kind of people should think about, at least with respect to what I'll say the mathematical end of the world. Okay? Now, when we think about investment strategies, what the money manager is doing, the goal is, in general, at least as far as we're going to concern, it is not picking the right stock, okay? Picking which stock is going to be the best stock that's going to go up and put all your money into that one stock. What turns out to be as for reasons we'll see today, okay, a more important part of the business, okay, is constructing and managing portfolios of large numbers of different stocks and weighing how much you have of each, okay? And that's where actually there are, reasons to believe you can do things in well-founded ways to optimize your objectives by thinking about a whole suite of, optimizing a portfolio. And there's a whole theory of how do you build portfolios to achieve different things, and that's what I'm going to try to talk about today. One thing I'm not going to talk about today, but gets into some of the, let's say, more tactical trader-ish issues, is that there are things that may go involved in buying or in selecting an investment portfolio. which are messier things to deal with that we're not going to talk about. So one example is in the United States, there are tax liabilities when you sell stocks. Okay, there are capital gains that if, let's say, I put money in the stock market, I invest $100,000, I sell it after a certain amount of time, and it went up to $150,000. I have to pay taxes on that $50,000 of gains that you have. I don't think that's true here. Is that not? It's not true here, but it's true in other countries, and it's true and there probably are similar issues here in some sense. What I will say is confounding issues that have little to do with the way markets work, but issues about how, let's say local laws and regulations and tax issues. And there are often issues when it comes to finding the right trading strategy to worry about what your tax liability. So for example, in the United States, you pay more taxes if you hold the stock a short period of time before you sell it than if you hold it for a long time. Okay? And so the question of when to sell something might be governed by tax issues more than, and that when you can get credit for losses, there are often complicated other issues in here. For now, we're not going to talk about that. We may talk about that a little bit when we talk about trading. But basically, we're going to look at constructing portfolios in the issue of risk versus return. Okay? Any questions? So there are a couple of different theories we're going to be talking about for managing portfolios. But the big issue is trying to design a portfolio so that we can modulate the level of risk that we're exposed to. That is really what the issue is going to be. That we're assuming that somehow everything about our market is known. There's no hidden stock that nobody knows about. Okay? We're assuming that that the returns on stocks are likely known. The fundamentals on stocks are known. And what we can do is to sort of modulate our value of risk, our level of risk, by designing a good portfolio. So as we've talked about risk in here, we usually talk about the variance in returns, okay, the volatility, okay, of the outcomes. And as we've talked about here before, when we have a risk-free investment like U.S. Treasury bills, the return is guaranteed, but it is fairly low. We buy stocks, in general, there is a higher expected return, okay, but there is more risk associated with it, okay? And what we're going to want to do is to try to design portfolios to give us as much return as possible for the level of risk that we're willing to stomach. That's really what the idea here is, okay? And the concern that you have about whether you're willing to stomach risk has to do with whether, as an investor, we've assumed that investors are risk adverse. That there's no reason that given two investments, if one is riskier than the other, the riskier one is less desirable. If I give you a choice of $1 or a coin flip for $1, where either you make $2 or $0, okay, on the outcome of a coin flip, it is better to have the $1 because there is a lower variance in the returns. There's no variance in returns there. The expected value is the same. Okay, and we assume that investors are risk reverse. Any questions? So what does it mean by risk? So far we've talked about risk as basically meaning volatility, that the prices up and down, the standard deviation in some sense of returns on a daily basis. That's how we've thought about risk. But there's other ways to think about risk, or more nuanced ways to think about risk. And one is to partition the risk into what we will call two different kinds of risk. Okay? When we talk about the specific risk or non-systematic risk of a stock, what we're talking about is the weirdnesses of the performance of that stock due to that particular things that happen within that company. Okay? So suppose, let's say, Sergey Brin suddenly takes all the money from Google. Okay? Packs it in his plane and flies off with it. Okay? That is a risk that Google faces that IBM does not face. Because Sergey Brin can't fly off with IBM's money, right? Okay? So there are some risks that are specific to individual companies. Okay? What is their management? What is our, people going to leave that company? Are people going to go into that company? There are, like I said, there are what I would call company-specific issues. Then there are also, the converse of it is that there are market-specific issues. Okay? That when we talk about systematic risk, okay, or market risk, we talk about the risk that is common to all securities. Okay? So we noticed we've gone through a very risky time. Okay, a time when it's been high volatile. Okay, highly volatile. What has happened to the stock of essentially every company? Okay, did it go up or down or neutral? What's happened to every company since I have started teaching? Okay, it has all gone down. Is there any stock that anybody knows that has gone up over the last? I haven't checked over the last 2 or 3 months. There must be one or two, right? There must be somebody who's done okay. But in general, almost every company has gone down. Now, if we think about it, why has every company gone down? Is it that suddenly everybody's management took their money, put it in a plane, and started to fly off? Or is it that they were all exposed to the same, let's say, external conditions, and the external conditions are lousy for everybody? Okay, I think that's what everybody would agree with, right? So there are two different kinds of risk that companies can, that you can face. One is the things that are unique to the given company. Okay? Will they do better or worse than their competition? Okay? The other is the market conditions. Will the interest rates go up? Will money be able to will people be able to borrow money? Things like this. Okay? And so the claim here is that risk or that volatility component can be deconvolved into two separate components. Okay? And we can get rid of one of those components if we're clever enough with our investment strategy. That's the big picture item here. If we're clever, we can get rid of the specific risk associated with a particular company. How can we remove or reduce our risk that Sergey Brin will put the money in a plane and fly off? Okay? The way we can reduce it is by not putting all of our money into Google. Okay? If all our money was in Google, then we are highly vulnerable to a particular Google-specific problem. Okay? On the other hand, if we own all companies, okay, or with a particular fraction here, we are less sensitive to to specific risk, okay, and all that we are left is the market risk. Does that make sense? Any questions about that? This is the argument for why diversification is a good idea, okay? Not that it can eliminate all risk, okay, but that it can eliminate the specific risk associated with a particular company. Any questions? Okay? So let's think a little bit more about this now. Suppose, let's say, that if you're making a decision, let's abstract it where, for a particular company, okay, every company, we have an idea as to what its expected return is. Okay? So, each company perhaps, in principle, if you think about, let's say, what do you do when you do your stock analysis or your fundamental analysis of these things? Somehow, we might have an estimate for every company about what its expected return would be. Maybe that's what it's been returning in recent weeks. Maybe that's what it should return based on what its assets are. Whatever, let's say we have an estimate. Okay? If we have 10 companies, each of which is paying 10%, okay? Let's say you have a bunch of companies here. Okay? If each of them is paying off, has the same expected return. Let's say each of them has an expected return we think will make about 10%. Which one are we best off owning? Okay? The answer should be, well, first of all, part of it would depend upon what the level of risk is associated with the company. Does everybody agree with that? Different companies are going to have different levels of risk, some systematic, some specific. Okay? Maybe a company has a CEO with a plane license. Okay? He may be more likely to fly off with the money. Okay? That company would have a greater specific risk, right? Some companies may react more strongly to changes in the market, okay, than others. That's what we mean by, getting the words mixed up, but that's what we would mean by market risk, systematic risk, okay? So, if we have a world where you've got a bunch of companies, each of which has the same expected return, okay? Which one of them should we own? If they all have the same, let's say, this is the risk, this is the same standard deviation of returns, it should be clear that owning a mixture of these would be a better thing than owning any one of them. If they have the same return, if they have the same returns and the same standard deviation of risk, okay, measuring risk, if we own a combination of them, perhaps equally weighted, okay, then what would we do? Our expected return would still be 10%. And our standard deviation of returns is going to be lower. Okay? Well, that is lower if these things are independent. Let's think a little bit about this for a second. Suppose we have a bunch of companies, each of which, let's say, have the same volatility. Okay? And each one of them have a risk, okay, that's composed into, let's just say to make it easy, there's an equal amount of systematic and non-systematic risk. Okay? They all have the same amount of market risk and the same amount of specific risk. Okay? If we owned equal amounts of each company, we would have the same market risk, okay, as if we owned one. But the specific risk is going to go down. The variance due to the weirdnesses of each company, we're going to be faced with 1/5 as much exposure to that, okay, as if we had owned one individually, okay? And so the argument is that the variance, the number of, the total amount of risk that we are exposed to is going to go down. Said that in a pretty ham-handed way, but I think that's a pretty obvious thing. Any questions? Okay, but let's think a little bit about something else here. Suppose I have two assets on the market I could buy. Okay, both of them paid 10%. Okay, one of them had a higher variance volatility associated with it. This had a 25% volatility. This had a 35% volatility. If you're allowed to buy one of them, which one of them are you going to buy? Okay? In general. As a risk-averse investor. You have two investments, both of which where the expected return is the same. Okay? We've looked at that, we've charted their returns over the last year. And both of them have paid off at 10%. Okay? One of them has done so with a daily volatility of 25%. One of them has done so with a daily volatility of 35%. Which is a better stock to buy if you only could buy one? What? Okay? A, the one with the lower risk. Does everybody agree with that? Right? We are risk-averse investors. and we can get the same return from both of these stocks. Okay? Which one would we tend to buy? We would tend to buy A instead of B. Does everybody agree with that? So, if so, what would happen to the price of A versus B? If we live in a world like this, where we have seen the expected returns of these companies right now are the same, but this one has a lower volatility than this one, what would we expect to happen to the prices of these companies? Okay? The prices of the stocks. Well, if people want to buy this one, everybody agrees this is a better thing to hold than to that. Does everybody agree with that? So if that's true, what will happen? If people start to buy this, what will happen to this one? The price will increase, and the returns will decrease. Does everybody agree with that? Well, why is it? Momentarily, let's say the returns are, let's just think about this. I guess we haven't made that causal connection here. Let's think about it. Intuitively, if we view the returns as being there are a couple different ways to throw it. Why is this company paying these returns? In theory, I guess, getting back to fundamentals, the returns represent how much cash the company is throwing off. How much wealth is it getting in its own business? Everybody agree with that? Okay? If we believe that the returns are due to the fundamental values of the company, and that you have two companies, both of which are throwing off 10% of the cash, okay? If more people want to buy this, the price of that stock is going to go up. The returns as a percentage of cash returns from you is going to go down. Right? Okay? Wait a second. If the other issue is that if you have a company that is less desirable, it's clear its stock price is going to go down. Okay? Because if its stock price, because if people are less interested in buying it, by supply and demand, the price has to go down. Does everybody agree with that? If the price has gone down and it's throwing the same amount of cash off, okay, the returns from that stock are going to go up. If we view the returns as being the amount of profit in some sense, returns per share. Does everybody see that? I think that actually I've explained properly now. Okay? So what's interesting about this, if you believe this analysis, one thing that's interesting is that the price of the returns given from a stock, okay, are going to eventually become inversely proportional to the risk. Okay? Because the riskier stocks are going to have to command, that if they, again, I'm getting stumbled here, but basically I think it's clear. If you had a situation where you had a riskier stock paying less money than a less risky stock, no one would want the riskier stock, right? No one wants the riskier stock, the price drops. As the price drops, the returns on it, in the future, the expected returns will go up. Because that doesn't really affect its fundamental mission as a company. Okay? And so the net result here is that we would expect that the returns of a stock are a function of its volatility. That's actually the interesting part of the theory here. Okay? Any questions? We'll explain that more deeply later. Okay? But so what's interesting here? The bottom line is that we own several stocks. Okay? We are better off owning them because with the same return. We're better off owning them because of specific risks. Because we remove specific risks. Because we're going to reduce the variance of the portfolio is going to be lower than the variance of holding individual stocks. And therefore, we're better off holding that portfolio, okay, than we are individual stocks. Okay? And further, the argument is that because of this phenomena where people are risk adverse, we would expect the returns in stocks to be a function of their volatility. Okay? The higher the volatility, the less desirable the stock is, the lower the price is, the higher a return someone has to get in order to justify paying for it. Okay? And so one thing that's going to come up in the whole theory here that's important is that we can somehow price what stocks should pay based on what their volatility is. Okay? Any questions? Something I said that. Okay. Let's keep going here. Okay? Any questions? So the theory that we're going to talk about basically says that that given a desired risk-return profile, that we can optimize the risk-return profile of a portfolio, okay, where a optimal portfolio is going to have the lowest possible level of risk over any portfolio that achieves its level of return, okay? If you think about it, as an investor, if you have a certain tolerance for risk, you want the highest return you can have subject to that level of risk. Okay? Or equivalently, if you want to achieve a certain level of return, you want the portfolio with the lowest level of return subject to that, the lowest level of risk subject to that level of return. Okay? And so the whole notion of the portfolio theory is to show that we can construct portfolios with certain levels of risk or certain levels of return. And the interesting thing to see here is that in principle, one can design a portfolio. Okay, if let's say you have one stock that is paying the highest possible return at what is presumably going to be a high level of risk. Okay? If you have a risk-free rate where there's zero risk here, and this is paying, let's say, 5%, it should be clear I can construct a portfolio that is going to achieve any level of return between 25% and 5% by buying some mix of risk-free assets and some mix of that. Does this make sense? If let's say I want to earn 13% with the lowest risk possible, one way, if these are my only two securities, one way I could do it, of course, is own half of this, put half my money suppose I put half my money into this and half my money into this. My return is going to be, okay, 17.5%, right? And my volatility, can be computed given the volatility here and the volatility here. Here there's no volatility, here there is something. It should be clear that as I modulate my percentage of stuff in the risk-free asset versus the risky asset, I could in principle earn any return possible between the highest rate one and the risk-free rate. Everybody agree with that? Now, as I add more assets to the picture, though, this may not be the best way to do it in terms of minimizing my risk. Okay? Does everybody get that idea? Or are there questions? I see some strange looks. Any questions? So the interesting thing about this is that, in fact, I can design a portfolio with any payoff I want. And then the idea of the portfolio theory is to try to figure out which is the best portfolio to do that in terms of minimizing risk. Any questions? Yes.
And in the process of constructing the portfolio, we need to know the expected return of the stock.
Right.
Actually, how can we measure the expected return in an accurate way?
Okay, so the question of how do you measure what the expected return is? So first of all, we agree that the best way to do it would be to read tomorrow's newspaper. Okay? But that presumably you can't do. Okay? So you can't expect to estimate it perfectly. On the other hand, how might you estimate what the return of the stock is? One is by looking at its return over the last year. Okay? That is somewhat of an estimate for what the return of a stock would be. Okay? One way it might be to look at the fundamentals of its business, saying this is a company that is according to its balance statement, on line to make $1 million of profit over the next year. That's supposed to go back to its shareholders. You can figure out what the profit is per share. That might be from fundamentals. That might be another argument. But the way we're going to do it is based on risk. We're going to be doing it based on volatility. The argument that I'm getting to here says that, by definition, the expected return should be a function of risk. It should be a function of the volatility, right? So if you look at companies and you look at what their standard deviation of returns is, you can figure out which is a riskier an investment than another one is. In principle, knowing the level of risk or volatility, if you believe this argument, that gives you some kind of a measure as to what the expected returns are. Okay? And that's sort of what this whole capital assets pricing model theory is, which we'll talk about later in the class. Okay? Is the argument that if you believe that risk and return are inversely related, and you can measure risk, you can in principle measure what the return should be, what the expected returns on that stock are. Any questions? Okay? Any other questions? Okay. So, again, diversification is an important thing, okay? The reason why stock index funds perform better than holding individual stocks, if I hold a random stock on the market, you would think that my expected return should be as much as the expected return on an index fund. And that's probably true. The difference, though, is that because if I own a portfolio of stocks, because the variance on the returns, the specific risks are going to cancel themselves out, it is better to hold an index fund than to hold a random company. Because although the expected values might be the same, the variance in one is going to be much lower than the other. Okay? Any questions? And understanding, let's say, what the amount of variance in something is important in assessing what, how different money managers perform. If you look at, let's say, again, mutual fund managers in the United States, we call them mutual funds, people who hold portfolios of stocks that they do. It is a phenomenon that almost all the managers, a large fraction of managers, don't do better than the stock index they are in principle trying to track. And why is it? Is it that they are stupid? Okay. Well, one argument is it may not be that they're stupid, but they're not actually smarter than the index. Okay. And that the ones that seemingly do better one year tend to do worse the next year. And why is that? Well, one reason is a lot of that is because, you know, if the returns on a stock are somehow its expected return plus the variance due to different specific risks and market risks, depending upon how the market itself performs, individual stocks will perform better. And depending upon specific factors, okay, which are unknowable at the beginning, certain stocks may perform better than worse. A lot of the difference in the performance of managers is largely due to this question of luck, how their specific risks come out, more than let's say specific individual skill. Any questions? So in general, again, there is a trade-off that as you hold more and more stocks, your variance is going to get lower, okay? Until ultimately, if you hold the entire market, you will have eliminated all of the specific risk, okay, due to the individual companies. because you sort of have diversified that away. And if that's the case, then you need to hold a certain number of stocks for diversification purposes. In practice, if you own about 15 well-selected stocks, you can get about as much diversification as let's say, the whole index. Any questions? Okay? Yes?
As you said, the diversification will cancel all the specific risks.
Yes.
Will it also cancel all the specific returns?
Well, so the question about specific returns versus specific risk, we sort of believe that again, the way to think about it, if your expected returns are 10%, there's going to be a window of uncertainty. Okay? Based on let's say the volatility, the risks and things like that. Okay? Now, if the variance cancels out, that's not a bad thing. Okay? It's about the expectation that cancels out. Okay? Let's think about it. You know, if you have, are we ever in a world, let's think about the question of the coin flip. If you have a coin flip that, you have a choice of owning $1, or you have the choice of owning a 50% chance at $2, and a 50% chance of 0. You bet $1 on a coin flip. Is this ever a better thing to own than this? Okay? You say it is if you get lucky, okay? But as a, let's say, investment strategy, is it better off holding the risky thing for the sake of it being risky? The answer would seem to be no, okay? That's why we're going to be trying to reduce our risk while modulating an expected amount of return, okay? Any questions? And sometimes when you diversify, okay, you will not, you can do better, okay? You can in fact possibly get rid of all the risk. Or sometimes when you diversify, you get rid of none of the risk. The issue comes down to how is the performance of the different companies correlated? Okay, we've talked about correlation. Suppose, let's say, that there are two companies, both of which return 10%, okay, a year. But they return it at different times, okay? Here we talk about, let's say, a company that, well, let's say we have a company that returns 20% in summer and fall. Let's say they sell swimming pools, okay? And another company that returns nothing in the fall, but returns a lot in winter. Let's say that's a ski resort, okay? If I own both of those, if I own one of them, okay, I have a return of, on average, 10%, right? But there is risk depending upon what season I buy. There is a high variance, okay, depending upon what season I buy. But if I own both of them, 50% of it, what's interesting here is I get a 10% return because each of them shows an average of 10% return. The interesting thing is that because these two companies are anti-correlated, I have no risk right now. Okay? The diversification would completely get rid of their risk if their performance was anti-correlated, or negatively correlated. Okay? Now you're saying, well, wait, what if the company does this? Why don't I buy this company in the fall, summer, and this company in the winter? And that you're 100% right about. But now let's say we've got two companies that are still anti-correlated. When this one goes up, this one goes down. Okay? So they're anti-correlated. But each day there is a coin flip to decide which one of them gets to go up. Okay? One of them is going to go up one day. If one goes up, the other one goes down. Right? Let's say one goes up and the other one stays flat. Okay? Let's imagine the following scenario, where one company either goes up by a unit X each day, or stays flat, The other company will also go up by X or stay flat. But let's say that they're inversely correlated. If one of them wins, the other one stays flat. You would expect a trace for this company to be something like this one went up, stayed flat, went up. The other company would have stayed flat, gone up, stayed flat. Does everybody see that? What would be interesting in this company case, it would clearly pay to own both companies. Why is that? Because the risks completely offset each other if they are anti-correlated. Okay? There is no variance. If I know that one of these guys is going to go up, and when this guy goes up, the other one stays the same. Okay? In this case, both of them, let's say, on average, will pay 10%. If I own one, okay, I will get 10% with a certain risk. Because these things are inversely correlated, there would be no risk at all associated with owning both of them. Does everybody sort of see that? Okay? So what I claim is that when you want to think about the diversification, the advantage of owning many companies depends upon how well correlated the companies are. Okay? Suppose we had two highly correlated companies that whenever, let's say, whenever company A went up, company B went up. Okay? And whenever company A went down, company B went down. Okay? Is this one is owning a mixture of them going to be any less risky than owning one of them? Okay? The answer should be no. Okay? If I take a look at your guys' grades on, let's say, in this course, let's say you guys were doing your grades and all your assignments together. Okay? The average grade in here is going to be, the return in here is going to be a, B plus, A minus, like in any other grad course, right? And if I took a bunch of students from here, and I averaged your grades are going to get closer and closer to the average the more students I take, right? Or the deviation in in expectation from the average is going to get lower and lower. But if I pick students who are working together on all assignments, their grades are going to move in lockstep. The risk that I get, okay, in their scores, okay, I don't get if I take two of them who are doing whose grades are basically paralleling each other, okay, then I don't get the benefit of diversification. I can tell that went over not at all, okay? But what are we going to be saying here? Okay, if I have two stocks that are very, very correlated, the benefits of holding them, okay, both for diversification are less than if two stocks are uncorrelated. Okay? If they're uncorrelated, when one goes up, the other one there is no reason to believe it also goes up. Right? If they're highly correlated, if one goes down, the other one is likely to go down. Okay? If they are uncorrelated, the effect of one stock is independent of the other. Okay? It is better to hold uncorrelated or weakly correlated stocks for diversification purposes than it is to hold highly correlated ones. Does that make sense? How many people does that make sense to? How many people don't quite get it? Any questions? Yeah, any question or just don't get it? Okay, good. Any questions? Okay? So what's interesting here is that when we talk about, let's say, trying to build a portfolio, one of the issues is going to be how correlated are the returns between different companies. Would we expect different companies to have different correlations between them? Is the correlation between Google and Yahoo likely to be stronger than the correlation between, let's say, Google and United Airlines. Okay? Which would we expect? Okay? What? What? Well, are they going to be correlated or so one question might be, if whatever is good for Google is bad for Yahoo, then they would be anti-correlated, right? But is everything that's good for Google bad for Yahoo? And I would say the answer is probably not. People decide that the economy is good. If somebody comes out with a report saying online advertising works very well, that's good for both of them, right? Now, a business between, if it was a zero-sum game, Coke versus Pepsi, perhaps maybe you would think they might be anti-correlated. But I think in general, the same companies in the same business tend to have fairly correlated returns. Okay? Just like, because for this reason that there are a lot of those systematic effects. What really is going to, yes, whenever something bad happens to Google, Yahoo, it's probably good for Google. But on the other hand, a lot of what's probably more important for what's happening to Google is what's happening in the outside world. If all the companies that advertise with Google are having a hard time, they cut back on their advertising. And that's bad for Google, right? So there are these, these different correlations here. The correlations are not necessarily what you would think. But what's the important point? For every pair of companies, we would expect there is a correlation in its returns. Some companies are going to be more strongly correlated than others. Some companies are going to be potentially uncorrelated. Okay? And some companies are going to be negatively correlated. In principle, if we want to reduce our risk, we are best off buying companies which are mutually uncorrelated or weakly correlated rather than strongly correlated. Does everybody see that? That, I think, should be clear. Because if they both pay 10% and the scores are uncorrelated, it is very unlikely that both of them are going to do worse than expected or better than expected. If they are highly correlated, then it is much more likely that both of them, will either do well or do badly. So the variance of returns in a portfolio of correlated companies is going to be higher than a variance of returns in uncorrelated companies. Okay? That actually should now be clear. Okay? Any questions about that? Okay? So in principle, we see companies that are uncorrelated or negatively correlated. Okay? The problem in the financial crisis now is that when things become bad, all returns become correlated. So let's say that, normally, let's say stocks move differently than bonds, right? Let's say certain asset classes tend to be relatively uncorrelated. Let's say real estate and the stock market tend to be relatively uncorrelated in general, compared to, let's say, Google and Yahoo. On the other hand, now that the time is bad, the correlations become much higher because the real estate market is dropping at the same time the stock market is dropping, at the same time everything else is going bad. Okay? Any questions? Okay? This might be, by the way, why some people like gold, let's say. Maybe gold is anti-correlated with the stock market. Okay? If that's true, then buying gold has a potentially good effect on diversification. Okay? Any questions? Okay. Let's be a little more precise about this now and look at what is involved with constructing a portfolio. Let's say we live in a world where there are only two stocks around, okay, IBM and Merck, okay? And the monthly returns on IBM recently have been almost 1.5%. And on Merck have been about 1%, okay? That would seemingly make IBM a better stock to own. Except that, of course, the riskiness, the variance on IBM stock has been greater than that of Merck lately. Okay? If there are only these two stocks in the universe, the set of portfolios we can build, if we have a certain amount of capital, is going to be formed by putting some fraction of it in IBM and some fraction of it in Merck. Okay? And it should be clear, if let's say I want, if I put it all in IBM, my return will be all in Merck, my return would be 1%. If I put it all in IBM, it will be 1.5%. Okay, and depending upon where I adjust the weights, okay, the fraction of it devoted to each, I can in principle get a return of either any point in between. Okay? The other thing, though, is that as I change my percentage of the holdings, the variance of my portfolio is going to change. Okay? I am given returns at this rate with a particular variance and returns at this rate with a particular variance. I can work out the variance of my combined portfolio. Is going to be, turns out if you work out the calculation, it depends upon a couple of different things. It depends upon the weight that I have in stock 1 times the variance in stock 1, plus the weight, the square of the weights in stock 2 times the variance of stock 2, plus a term that is 2 times the weighting fraction in each, times the amount of covariance between the two of them. If the two companies are independent, then this term is going to be 0. If the two terms are moving in lockstep, okay, where this is highly positive, the variance of my portfolio is going to increase. If these two companies have negatively correlated returns, the variance is going to be lower, okay, than it would otherwise be. So the argument here is that that I can compute the variance of my portfolio, and it depends upon the variances of each individual asset, plus the covariance of how much these two are related to each other. Any questions? So if we work through this, what we can show is that depending upon what fraction of the stock I had in IBM, okay, I can compute what is the standard deviation. Okay, if I just had IBM, my standard deviation was the square root of the variance. I would get IBM returns and IBM variance. I mean, I had Merck returns and Merck variance. Or I could get IBM returns and IBM variance. Or I could get a trade-off in between there. Okay? And that is well defined by the formula that I gave you just now. Any questions? The other thing is, it is possible to get higher returns, even in a world of just two assets, in principle, if I am allowed to short sell things. Suppose we live in a world where I have IBM stock and Merck stock, but I am also allowed to short sell one of them. One possibility is, if I expect IBM has a greater expected return, one trick I could do is to short sell some Merck, okay? Saying I will borrow 100 shares of Merck, sell it, put that money into IBM. IBM's expected growth rate is higher than Merck's, right? If I then, at the end of the period, sell my IBM and to buy back the Merck that I need, okay, we would expect a higher return, okay, through this short selling if I short sell the one with the expected lower return and use it to buy one with the expected higher return. Does that make sense? Okay, let me try this again. Okay. So suppose, let's say, I have a certain amount of money. Let's say, I have a certain amount of money, and I can put it into IBM or Merck. Suppose, let's say, I short sell. Let's say that this has a growth rate of 1% expected. This is a growth rate of 1.5% expected. One technique that I could do is, what if I borrow some shares of this and sell it? Okay? I now take the proceeds of that and put it into this. What would we expect to happen if there was no variance, if everything worked out the way that we're supposed to? A year from now, I will have to buy back this guy's Merck shares, okay? Which will have cost me 1% more than what I paid for them now, right? On the other hand, when I sell the IBM shares I bought with that money, the assumption is that I would have had 1.5%, right? So the assumption is that on expectation, this is a good thing to do. Does everybody see that? If I could short the one with the lower expected return and put that money into the one with the higher expected return, my expected return is going to increase, although my volatility is going to decrease, is going to also increase. Okay? Because I'm exposed to more risk. What happens if this one, in fact, doesn't grow? This IBM has a bad spell and Merck doesn't. Okay? Then my risk is going to increase. The interesting thing about this is that if you assume that I can I can put a certain fraction of my holdings into IBM and a certain fractions into Merck, and the fraction that I put into a part can also be negative, okay? If, let's say, I short a certain amount of it, okay? I can get a return profile that goes beyond just having the returns available in owning from the lower, from the lower return stock to the higher return stock.
Sorry, it's something
Yes.
bothering me there, because if you short, then at least in expected sense, you should be making more return.
Right, so what's this happening here? This is showing me making more returns.
Oh,
Okay? So what am I on my range of possibilities? Okay? If I am allowed to short a certain fraction of my holdings, okay? If I short the lower priced one, okay, the lower growth expected one, and use that money for the higher growth expected one, my expected value of returns would be higher than it would be if I just owned a certain, I am now owning in some sense a higher fraction, more than 100% of that company. The fraction of my holdings that are exposed to that country are now more than one. Okay? The expectation here is that I will have a higher return. But you can work through what the risk is. Okay? But the standard deviation returns are also increasing. So one interesting thing about shorting is I can use this to, in some sense, get a higher return at a higher risk, even than the higher performing stock in that world of one company. Any questions? Now, I also could short sell IBM and use that money to buy the slower growing company. Okay? And that would have the result of driving down my return. But it turns out that does not drive down my risk. Okay? I'm still facing more risk because, in fact, if IBM, the volatility of the variance of what I have goes up under those conditions. Okay? Any questions? Do people see how, what I think should be clear from this, do people see that in principle, if I don't short, I have to earn, in whatever portfolio, it would go between the lowest order stock, the lowest return stock, and the highest return stock. Okay? If I'm allowed to do short selling, in principle I can get higher returns. Okay? But of course the risk goes up. Any questions?
Is there any method to determine which proportion is the best? Because when the risk, when the mean when the payoff increase, then the risk also increase.
So the question that you're really asking now is an interesting one, and a question that's a personal question. Suppose, let's say, we have this horizon of portfolios. Which of these portfolios is best? Okay? I claim you can't really tell. Okay? It depends upon you. We can tell which one of these are not good. Which portfolio would not be good? I claim this would be a terrible portfolio. Why? It's got a low return, but its volatility, its risk is higher than that of other ones. Okay? Does everybody see that? This one, in fact, over here, owning just Merck, would be a lousy portfolio. Why? The return on Merck was 1% and the volatility was 6%. If I mixed in 20% stock, IBM, and 20% Merck, my return is higher, and because of diversification, my risk is lower. The interesting thing here is, I think we get a curve, that if you work through this, there is sort of a frontier of portfolios, depending upon what fraction of the stock you hold, okay, of which stock you hold. Here is the risk axis. Here is the return axis. What's interesting about it? If you just hold Merck, you sit here. If you just hold IBM, you sit here. If you own a fraction of it, as you increase the fraction of IBM up to a certain point, as you increase the fraction of IBM, your returns are always going to increase. That much we agree on, right? The interesting thing is that there is going to be, because you eliminate, depending upon what the covariance is between the stocks, okay? At some point, up to a certain point, you reduce your total risk while you're increasing your returns, okay? But then from here on up, you have increased returns at increased risk. And the question of which point here is best, that depends upon your particular appetite for risk, right? You may say, well, I want to be here with the high returns. Well, you do that up until the point where you lose all your money, right? So people have, so what the claim here with this theory is, I can't tell you what the best portfolio for you to have is, but I can tell you which portfolios are less good. These are less good, okay? And I can tell you now that the trade-off here, it gives you a precise characterization of what is the return versus risk portfolio. Okay? Any question? This portfolio, this curve we call the portfolio frontier. Because we're going to live in a world where, for any investment vehicle, there can be lots of different portfolios you might hold. The ones that are going to be interesting for you to hold are the ones that minimize risk for a given return, or equivalently maximize return for a given risk. Any questions? Okay, we'll talk more about this theory next class. Okay, and start about some other things. I'd like to take the last few minutes and talk about the homework assignment. I said I'd give you 2 homework assignments this semester. The one this particular homework assignment is going to be one about you evaluating trading strategies. Okay, we're going to be talking about trading strategies in the next over the next few lectures. What I want you guys to do is to become investment managers and come up with basically algorithmic trading strategies and evaluate how well they work. So what do we do? We have prepared a data set representing 10 years worth of daily price data on essentially the Fortune 500 companies, or the S&P 500 companies. And we have prepared a simulator program that, given the trajectory of prices, okay, if you told it what you were going to be, that if you give me a stream of orders, buy this stock on this particular date with this much of it, and sell this stock on a particular date, it will keep track of how much profit you made or lost. So what I want you to do basically is to conduct experiments on different trading strategies and evaluate how well they perform. We're going to talk more about more interesting trading strategies over the next couple of classes. Okay? But one strategy, I want you to basically first implement a few very simple strategies. One strategy would be you look at the stock market and you do nothing and don't buy and sell anything. Okay? You put that and just leave it in the bank. That's the mattress strategy. Buy and hold would be, at the first day of trading in the period, you buy equal amounts of every stock and you ignore it. You then wake up at the end of the period and see what happened. Okay? Diversification with rebalancing is a little bit more clever and more active, which says that you want to hold equal amounts of each stock. But some stocks tend to go up and some stocks tend to go down. At regular intervals, you should sell the ones that have gone up and buy the ones that have gone down, so that you always hold an equal proportion of all of them. Okay? That's what I mean by these. These are all very simple baseline strategies. What I then want you to do is to also try to develop some other strategies and evaluate them and see how they do. Okay? That's where I think the fun part of the assignment is going to come in. Okay? We will talk about different trading strategies, okay, in the next couple of over the next couple of classes. But what the purpose of the assignment is you are to go to our webpage, okay, which is in here. So go to my webpage. And things you can download are data sets of prices. You can download our simulator, which takes orders in the format we describe over here, and will keep track, given a trace of orders from you, how profitable or not your strategy was. Does that make sense? And your goal now is to evaluate different strategies and write a report as to how well they do. That is the purpose of this assignment. Okay? Any questions here? Okay, people get an idea of what the basic purpose of the assignment is going to be. Okay? Any questions? Okay. Let me just go over the rules of the assignment a little bit. Okay, make sure everybody understands this a little bit. The goal here, look, I want you to look at the rules of the game section, because this is an important part of the assignment. The goal of this assignment is not to find the most profitable strategy. Okay? For several different reasons. Okay? One is it's going to be very easy for everybody to cheat. I'm giving you a file of all the stock price, the prices of this stock for the next 10 years, and asking you to come up with a trading strategy for this stock. Right? Let's say it's Google. If you wanted a strategy to maximize Google's returns, your returns on owning Google, it should be one where you look ahead to tomorrow, see if the price is going to go up or down, and then sell it or buy it today based on that. Does everybody see that? So it does not take a genius in order to make a tremendous payoff, to come up with a trading agent that comes up with an arbitrarily high payoff here. It takes a cheater, not a genius. Okay? So my goal here is not to see you come up with the most profitable strategy. Okay? My goal here is for you to try to develop some well-defined trading strategies. Evaluate them and play with them. Okay? Any questions about that? That is rule number 1. Again, it's also rule number 2 and rule number 3 if you look at the rules for the assignment. Okay? Rule number 3 is the most interesting. I promise I will take off 5 points from the paper of whoever has the highest, most profitable trading strategy. Okay? Because those people will probably have done it wrong or cheated. Okay? So I want you to, my goal here is that people do an honest evaluation of things and see what happens rather than try to maximize it. There's several ways to cheat here. Okay? And my goal is for you not to cheat. Okay? One way to cheat is to look ahead explicitly. And that is obviously transparently cheating. Another way to cheat is to run several thousand simulations of different strategies and pick the one that performed the best. Right? Because again, you know what the future is in some sense when you pick the best of these strategies. Right? So that's why, in fact, we break the data set into 4 different chunks to encourage you to actually test your strategy on one chunk and evaluate it on another. Okay? So another way to cheat is with too much short selling. The simulator we have allows you to do short selling. Some of the strategies you do probably should implement short selling. But it is something that is potentially abusable, okay, if you do something silly here. So what I want you to do is, the assignment basically is, write your own simple trading agents, simulate them to see how they do, and write me a report about that. Any questions about what the assignment is? I know you have to read it in order to find out. Okay? Any questions? My strong encouragement for this assignment, I think this assignment should be fun, and I look forward to discussions about it. My strong encouragement is that you try to do the baseline strategies as soon as possible. Like write a strat program that just basically takes all the money and puts it in the bank. Okay? That should be approximately 3 lines long. But I want to make sure you can test the simulator and you see what the results are and that we debug any problems with our simulator that we may have. The quicker we do that, the better off we are. Any questions about the assignment? Okay, think about that. Good luck, and we'll talk more about this next class. Okay? And I have homework 1 grades here. Okay? If people want to pick them up, come and pick up your homework 1s. And I'll see you guys next class. Okay, thank you.